If you own an apartment building, you've probably asked yourself this question: what's my building actually worth? Maybe you're curious, maybe you're approaching a refinance, or maybe you're wondering whether selling makes sense. You already know the costs have gone up, and in most cases, faster than rents. Insurance premiums, maintenance and repairs, property taxes, overall expenses across the board have gone up. But here is what most owners do not know: how much these changes have quietly shifted the value of their building. In the next 15 minutes, I'm going to show you exactly how apartment building value is calculated, what the biggest mistake owners make when estimating it themselves, and how to get a realistic value range without guessing or spending months speaking to the wrong people. Once you understand these ideas, evaluating your building becomes much clearer. If you own an apartment building, this may be the most important 15 minutes you spend this year. Hi, I'm Shafiq Karani, and for the last 30 years, I've been working with small to mid sized apartment building owners just like you who want to make better decisions about value, income performance, refinancing, and sometimes selling. Over the years, I've worked with owners of buildings ranging from 3 units to hundreds of units. The buildings look different, the markets are different, but the questions owners ask are almost always the same. What's my building actually worth? Can I refinance and get a reasonable proceeds? And is now a good time, or should I wait? These are exactly the questions we're going to answer today. In this video, we'll walk through four key areas. First, why value is a range and not a number. Second, how value is calculated. Third, why NOI and cap rate matter. And fourth, why most owners do not see the NOI haircut coming. Once we cover these four areas, we'll also talk about three strategic options most owners eventually consider: improve their income first, refinance their building, or sell their building. Let's start with the surprise almost every owner I speak with. Most owners ask a simple question: what's my building worth? But the real answer is more nuanced, because apartment buildings do not have a single value. They have a range, and that range is driven by who is evaluating the building and what assumptions they are using. Here's why that matters. A lender evaluating your building for a refinance will apply conservative expenses, assumptions, and focus on debt coverage. A buyer looking for upside will apply different rent projections. A broker pricing for a quick sale will apply different cap rates and assumptions. Same building, same rent, but different numbers. When I evaluate a building for an owner, I provide three numbers. A conservative value. This is what a cautious buyer or lender might see using strict assumptions. A base value. This is what most transactions tend to land under normal market condition. And the optimistic value. This is what the building could be worth if income is improved or the buyer sees upside. Online estimates, Zillow, Redfin, automated tools are essentially meaningless for apartment buildings. They are designed for single family homes and do not account for income performance, which is the primary driver of apartment value. I recently worked with an owner of a 12-unit building. The owner believed the property was worth about $7 million based on a conversation with a neighbor. After reviewing the financials and normalizing the income, we found the conservative value was closer to 6.3. The base value was 6.8 million, and the optimistic value was 7.2 million. if were gradually brought to market. The range gave the owner clarity about what, instead of rushing to a refinance at the conservative number, they chose to improve the income first and refinance later under better terms. Every apartment building has three values: conservative, base, and optimistic. Understanding the range is the foundation to every decision that follows. And that brings us to the second area. If value depends on income, the question is, how is income actually measured? Income drives value. More specifically, NOI drives value. NOI stands for the net operating income. NOI is not your bank balance. It's not what shows up on your tax return. It's the income the property produces after operating expenses, calculated the way lenders and buyers expect to see it. Here is how it works. You start with the gross rents, everything the property collects at full occupancy, then subtract vacancy, then subtract normalized operating expense, then subtract the management fee. And this is important even if you self manage the building, and then you subtract the reserve for capital replacement. What survives all these deductions is your NOI. For example, if the building collects $800,000 in annual rent and operating expenses, including the management fee and reserves, are $300,000, the NOI would be $500,000. That $500,000 is what investors, lenders use to evaluate the property. NOI is the most important number in an apartment building valuation. Before we move on, ask yourself this. Do you actually know what your building's
NOA.
is? Not what you collect, not your tax return number, the normal NOI, the one a lender or a buyer would calculate. Most owners I work with are surprised when we calculate it together. One of my clients had rents that were about 10% below market. By adjusting leases gradually over 2 years, the NOI increased by about $60,000 per year. Because the building was trading at roughly a 5 cap, that improvement in income created more than $1 million in additional value. I call this the income multiplier effect, and this is one of the most powerful tools available to apartment owners. Income drives value. The specific income number that matters is NOI, normalized the lenders and buyers expect. Knowing your real NOI is the starting point for every decision. If you would like to help reviewing your building's NOI, you can upload your rent roll and financials using the link below, scan the QR code, message, or call me. But knowing your income alone does not determine value. We need to understand how the market prices that income, and that leads us to the third
Area.
investors do not simply look at income and multiply it by a random number. They apply a market measure of risk and return. That measure is called cap rate, short for capitalization rate. Cap rate represents the return the buyer expects from a property at a given price. The basic formula is straightforward. Value equals NOI divided by the cap rate. So if the building produces $500,000 of NOI and the cap rate is 5, the estimated value is $10 million. The cap rate is fundamentally about risk and return. Higher risk properties, older buildings, deferred maintenance, high vacancies, difficult locations require higher returns from buyers. That means higher cap rates. The higher cap rate means a lower value for the same income. Low risk properties, stable tenants, well maintained buildings, strong locations justify lower cap rates for buyers. And the lower cap rate means a higher value for that same income. This is why improving the condition and income stability of a building can increase its value from two directions at once: higher NOI and a lower cap rate applied to that income. One owner I worked with improved property management, stabilized tenants, resolved deferred maintenance over about 18 months, and the perceived risk of the building decreased. The buyer was willing to accept a lower cap rate. That combination of a higher NOI and a lower applied cap rate resulted in building significant the building value significant without any changing in market conditions. Value is determined by two factors: NOI and cap rate. Impacts the value. Improving both impacts the value of the building can be substantial. Before we understand income through NOI, how the market prices that income through cap rate, but there is one more area that constantly surprises owners, and that's the fourth area, the NOI haircut. It is what happens when lenders and buyers start adjusting the numbers. This is where most owners get surprised. Not because the building is bad, but because their numbers are not presented the way lenders and buyers expect. I call this the NOI haircut. It is where value gets reduced. Here are the most commonly adjusted reduced NOI when a lender and a buyer evaluate the building. Under market rents, good news for the buyer, but it means that income today is lower than what the income could produce. One-time income spikes, late fees, laundry income that is usually high, one-time payments, these get removed from the normalized calculations. Missing management fee, even if the property is self-managed, lenders add this anyways. This is one of the most common surprises. Understanding expenses. If repairs have been deferred or insurance has not been renewed, these expense bases look better than it is. The lenders know it. Low or missing reserves, lenders typically add a reserve for replacement, even if the owner has been not setting one aside. Now, none of these issues are fatal, but ignoring them going into a finance or sale can be expensive. Here's something most owners don't realize: a building can sell at a reasonable price and still finance poorly. This is because lenders evaluate buildings differently than buyers do. Buyers can underwrite future upside, projected rent, increases, planned improvements. Lenders focus on a specific ratio based on current income. This ratio is called DSCR, the debt service coverage ratio. DCR compares the property's NOI to the annual loan payments. If a building produces $500,000 of NOI and the annual debt payments are $400,000, the DSCR is 1.25. Most lenders want to see a DSCR of at least 1.20 or 1.3. That cushions tells the lender that the property generates enough income to cover the loan payments with a little room to spare. With interest rates rising, loan payments are higher, which means the same income supports a smaller loan. That is exactly why the rate environment affects refinancing proceeds and the price. I recently reviewed a property where the owner expected to refinance for a loan amount significantly higher than the lender approved. The building had equity, the rents were solid, but after the lender normalized the income, added the management fee, removed the one time income, added reserves, the DSCR became lower than the threshold. The loan came back more than $400,000 below what the owner expected, not because the building was weak, but because the numbers weren't prepared the way the lenders needed to see them. Because we reviewed these numbers early in the process, the owner was able to improve income first, and the lender 6 months later in a much stronger position. This is exactly the kind of outcome that understands these four areas must make. Lenders evaluate buildings differently than owners and differently than buyers. They normalize the income and focus heavily on DSCR. Knowing your DSCR before you approach a lender or list your building for sale protects you from expense surprises. If you want to understand how lenders would evaluate your building today, upload your information using the link below, scan the QR code, message me, or call me. Now that we've covered the four areas that determine value and the specific options that most owners become much clearer. Based on what we have just learned about your NOI, your cap rate, and your DSCR, most owners find themselves in one of three positions. Option one, improve their NOI first. If the rents are below market, your expenses are higher than they should be, or your management has room to improve, the highest value move may be to focus on NOI first because every dollar of substantial income improvement multiplies into value. Option two, refinance your building. If your building has strong income and a healthy debt coverage, refinancing may allow you to access equity while continuing to hold the property. Understanding your DSCR before you approach any lender is the difference between a smooth process and an expensive surprise. Option three, sell your property. Sometimes selling is the smartest next move. If you need capital, if needs capital are approaching, if you want to redeploy equity into a different asset, or if the market conditions are favorable, selling at the right time and with a well prepared income picture can make a substantial difference and what you walk away with. There is no universal answer. The right option depends on the current income performance of the property, the financing environment, and your long term goals. But here is what I know for certain. Owners who understand the value range, their NOI, their DSCR before making a decision constantly make better decisions than those who are working from guesswork. Before we finish, let me quickly review the four areas we covered. First, every apartment building has three values: conservative, base, optimistic. Understanding the range is a starting point. Second, income drives value. That number drives NOI, normalized for your lenders and buyers expect. Third, cap rate determines how income translates into value. Improving both NOI and perceived risk can increase value in two directions. And fourth, DSCR determines how lenders evaluate a building. Knowing your DSCR before approaching a lender protects you from expensive surprises. Once you understand these four areas, the three strategic options, improve NOI, refinance, or sell, become much easier to evaluate for a specific situation. So if you're watching this and wondering where your building fits in these concepts, this is exactly where a professional evaluation becomes helpful. When owners ask me what their building is worth, I do not guess. I analyze. I review the rent rolls and the trailing 12 months. I normalize the NOI. I apply market appropriate assumptions and I provide conservative based and optimistic value estimates along with specific factors that impact those numbers. Plus, I make specific recommendations whether you should improve NOI first, refinance, or consider a sale based on your building's actual numbers and your situation. If you would like me to do this for your building, click on the link below, scan the QR code on the screen, send me a direct message, or simply call me. Upload what you have, even if it's messy, and I will send you a realistic value and the smartest next move for your specific situation. No pressure, just clarity. Thank you for watching. Click on the link below, scan the QR code, message me, or call me. I look forward to speaking with you soon.